Hello and welcome. I'm Christian Peter from Dark Horse Commercial, and we are back for another edition of the ultimate guide for Miami warehouse owners, how to sell for top dollar. So, as I mentioned in the overview video, we're going to be talking a little bit more in depth today about understanding the Miami industrial market, the supply and demand trends in Dade County today. Now, it's no secret if you've owned a property in Dade County for the last 5, 10, 15, maybe even 20 plus years, you've seen a distinct uptick in the rental rates, right? So if you go back to before 2008, things were chugging along nicely. We took a major hit from 2008 to about 2012, 13, and then the rents started ticking up nicely, nicely, nicely. And along the way, we saw great rent appreciation. It wasn't until we had the kind of black swan event of COVID that things really changed. As an example, I purchased a property in 2000. I put it under contract in 2019, got it under contract, and I was figuring on $8 a foot rents. Today, we're averaging over $20 a foot for that exact property. So, in terms of rent appreciation, we've seen a very, very unprecedented time. Not to mention, a lot of people started moving in from other parts of the country, California, the Northeast, New York, Jersey, Philly, etc. So, what we've seen is not only an increase in demand, but we've also seen that very few people are building in particular, small bay warehouses. So if you are enough to own small bay warehouses, what you'll see is the rent just keeps going up and up and up and up. And from an investor standpoint, there's nothing better than decreasing or basically supply staying the same and in a serious increase in demand like we've seen the last 4 years. So we've seen rents more than double in the last 5 years, more than we've seen in any 5 year period previous, probably more than we've seen in most average 10 to 15 year periods. Let's talk about cap rates, lease rates, and buyer types. So, what we're seeing a lot of nowadays is the cap rates are a bit compressed compared to where you can borrow money at. So, as of the filming of this video, you can get money for about, let's say, 6.5%. But a lot of people are buying at cap rates that are not far off from 6.5, maybe 7%. Typically, when an investor buys a property, if you're going to borrow money at, let's say, 6.5%, you're going to want at least 1.5 to 2 points of spread, or 150 to 200 basis points, depending on what vernacular you use. But typically, you're going to need a spread of about 1.5 to 2 points above that. What we're seeing is a lot of times people are buying more or less kind of at today's cap rate, maybe a little bit above, or I should say above their cost of funds. And then what they're doing is they'll buy something that they see appreciation in, and that will tick up over the years. So what's interesting is normally in a normal market, if you were in some sort of secondary or tertiary market in the rest of the United States, Miami is a bit of an anomaly. You would see that the people that own properties and they're going to sell them, if you can borrow money at a 5, they're selling it for a 6.5 cap. If you can borrow at a 6, they're selling it for a 7.5 cap. Miami is one of the few markets where the cap rates are a bit compressed in relation to the cost of funds, or what it costs to borrow the money to invest. In terms of lease rates, what we're seeing in the Doral, Medley area, we're seeing anywhere in the 19 to 23, $24. Asking, most people are getting that a little bit north of 20. In the Hialeah market, as an example, what we've seen is probably around the 19, 20, $21, depending on the size of the unit, of course. If you're talking about less than, say, 7 or 8,000 square feet, you can get right at that $20 a foot mark. If you're seeing bigger than that, obviously it's going to be slightly smaller as economies of scale do come into play. But that's pretty much what we're seeing kind of in that airport vicinity, Airport East and Hialeah, and Airport West being Doral, Medley, and then that sliver along 72nd Avenue corridor. It's usually just a little bit less than the Doral market. And then finally, buyer types. There's going to be several types of buyers that are coming into the market. There's going to be flight capital, as always. So whenever one of the other countries, outside the United States has a decrease in the value of their currency and people want to denominate their dollars, I should say their money in US dollars, we're going to see a bunch of flight capital. Those are the very people that will pay more for a warehouse. Now, here's the caution, and here's something that I've seen happen over and over and over again. Many sellers are waiting for that, what I call unicorn buyer, the 1 in a million buyer. Unfortunately, we don't make the market. And every once in a while, you hear stories about these unicorn buyers, but they are more the exception to the rule than the rule itself. The other types of buyers, depending on the size of the property, if you get over, say, 50,000 square feet or so, then you're going to have more the institutional buyers. Institutional buyers because they borrow money from other people, usually cheaper than you can borrow from a bank, and then they invest that money. What they're able to do is they're able to buy at a lower cap rate than the average mom and pop investor. And then finally, there are the mom and pop investors. Those are the folks that just everyday people that are just looking to make a return. They're looking to borrow money, like I said, at let's say a 6 or 6.5, and they need that 1.5 to 2 points of spread for the deal to make sense to them. As kind of a subset of those flight capital people from other countries is flight capital folks from within the United States. You've heard a lot, especially what's going on in New York nowadays. People are kind of up in arms about what's happening with the newest mayoral race. So we still are seeing a fair amount of people moving down from the Northeast. So I would be on the lookout for that in the months and years to come. Let's talk about why timing your sale is everything in this market. Okay, so if you're at home, raise your hand if you remember the 2008, 2009 period. I remember it. I was managing 125 tenants at that point, and I remember what happened over the next 3, 4, 5 year period because it was one of the toughest times in U.S. economy. Now, not saying that that's going to happen again, but I think we all can agree that over a long enough time we see cycles. Okay, the average, if you listen to economists and that have studied this since the Civil War time, since 1860, the average economic cycle is 18.6 years. So if it's 2025 now, if you go back 18.6 years, guess what? We were right at the peak in those years. So a lot of people are talking about there being a pullback. Things can't go up forever. Oftentimes, just like in the stock market, there tends to be a retracement in value. So if you are considering selling in the next 1 or 2 or 3 years, I would start putting that as less of a rear burner activity to more of a front burner activity. Why? We are due. Think of it like this. It's the end of October and you see the leaves start to change colors. Now, I don't know when the first snowfall is going to fall, but it will happen. Winter is coming. The question is, will you have prepared your house before the snow comes, or will you be waiting to go buy a shovel after, the first 6 inches is on your sidewalk? To use this metaphor, the question is, if the timing of your sale is if you're thinking about timing your sale in the next 2, 3 years, I think now would be the time to start preparing for that period. Nobody likes to get caught kind of behind the 8 ball. So I hope this has helped. We're going to be diving into future chapters as the videos increase. So go ahead and stay tuned. Keep your eye out on the email or on the YouTube channel if that's where you're watching. And we look forward to seeing you in the next video. Thanks for tuning in.